Good evening and welcome to our annual member meeting for 2023. My name is Paul Northey and I am the Chief Growth Officer for CareSuper. In the spirit of reconciliation, CareSuper acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present, and we extend that respect to all Aboriginal and Torres Strait Islander peoples here today. We are proud of CareSuper as a leading profit-for-member industry superannuation fund, whose sole purpose is to act for our 220,000 members, not shareholders, managing your hard-earned savings and helping you to achieve your best retirement. Tonight's event is to give you, our members, an opportunity to hear how CareSuper has tracked over the past year, along with providing you an outlook from the fund for the year ahead. We have 3 presentations from the most senior leaders of the fund. These will take around an hour, followed by 30 minutes for us to answer your questions. You'll notice that the presentations from our speakers have been pre-recorded. This is to minimise any potential issues technology can throw at us, and to make sure you have a positive experience. You can ask questions starting now by posting them into the Q&A function at the bottom of your screen. After the presentations, our speakers will all return live, where they will answer as many of your questions as we can get through. As we look back over this last year, perhaps we can finally say that our lives have returned back to normal after the COVID pandemic. At the same time, there continues to be challenges, most notably the rising costs of living, a housing and rental crisis, and growing economic and geopolitical uncertainty. But on balance, hasn't it been fantastic to see the crowds at the Women's World Cup, at the AFL and NRL Grand Finals, and the Grand Prix here in Melbourne earlier this year? While the airports have been a bit chaotic at times, it's brilliant to see people travelling again. Sadly, I'm not one of them. I'm sure, like you, I've seen and known lots of friends, colleagues, people who have travelled to Europe, Asia or the States, and importantly for our economy, here in Australia too. My son is one of those, as he jets off to Texas to celebrate finishing the end of his school days after completing Year 12, and will spend some time with family there. Each of you will have your own experience this year, but we are grateful we can play a role in looking after your hard-earned superannuation savings. We hope tonight helps you stay informed of things which you need to know about CareSuper and provide you confidence and reassurance that you are a member of a high-performing and leading superannuation fund. So thank you for joining us tonight. We have 3 of our most senior leaders from our fund to present to you. Councillor Linda Scott is the Chair of CareSuper's board, responsible for the governance of the fund. Linda will provide an overview of the big picture matters that the board have overseen, the key strategic issues it has faced, and a look to the future as our fund continues to evolve. Michael Dundon is our recently appointed Chief Executive Officer, who leads the CareSuper team in executing our strategy and the day-to-day leadership of the fund. Michael will update you about our upcoming merger and future direction for our fund, as well as present on key fund statistics and initiatives over the past year. Our final presenter will be Suzanne Branton, our Chief Investment Officer, who together with her team is responsible for investing over $21 billion of members' savings, focused on preserving and helping grow this vital asset, delivering returns to help you achieve your best possible retirement. Tonight, Suzanne will discuss the challenging market conditions which have dominated markets in recent times, our performance through this period, and provide insights into what's on the investment horizon. Remember, we are taking questions, and our presenters will be back live a bit later on. So if you'd like to submit a question, please use the Q&A function at the bottom of the screen. But please keep in mind that we may not be able to get to everyone's questions tonight, and we can't answer any questions that are of a personal nature. However, we are required to publish a response to all questions that are asked, so if we don't get to your question tonight, it will be answered in the minutes which are published on the website. I also need to tell you that tonight's webinar is being recorded, and by joining us tonight, you are giving your consent. The recording of this webinar will be available on our website within 30 days. We're required to publish a transcript of the minutes, as well as responses to all questions, and these will also be available on our website within 30 days. The recorded video on our website will include subtitles. The information provided in this presentation is of a general nature only. It does not take into account your financial needs or situation, and you should seek advice or read the product disclosure statement and target market determination document before making any investment decisions. We will now move into the presentations. I'll see you at the end when we look forward to answering as many of your questions as we can. Our first speaker is the Chair of the CareSuper Board, Councillor Linda Scott. Linda was appointed Chair in April 2022, having previously been the Deputy Chair and a member of the Board since 2018. Linda is an experienced Board Director and local government leader. In addition to CareSuper, she also serves as the Chair of the Australian Local Government Association. She's a Director of the Australian Council for Superannuation Investors and Councillor on the City of Sydney Council. Linda also serves on a number of Commonwealth government bodies and New South Wales government boards, including the New South Wales Environmental Trust. She participates in the annual CEO Sleep Out and is passionate about taking action on climate change and the creation of more affordable housing. Linda brings in-depth knowledge of culture, governance, risk and advocacy. Please welcome Linda.
Good evening, everyone, and thank you for joining us tonight. I'm so proud to be leading an award-winning fund, one with a genuine commitment to responsible, long-term investment practices that drive outperformance. Of course, we are run only to benefit our members, which means our decisions and our profits are all about you. Tonight, I'd like to share a few key things with you. Firstly, I'll provide an overview of the environment and impacts on super and our fund. And then I'll talk about our upcoming merger and future direction. And finally, I'd like to take you through some of the updates from the board and also take the opportunity to thank you and everyone else involved in our fund. Before I do, as a CareSuper member myself and passionate advocate for industry super funds, I'd like to share some of our member stories from this year to highlight the important role we have as a fund and how we've helped members make the most out of their super. One member story which comes to mind is about a new member. This person had previously come to Australia as a refugee and identified as vulnerable due to their literacy and language skills. This person's current super fund was closing and they felt they weren't provided with the service and support they needed. They were disengaged and didn't understand their options. So they searched other funds on the internet and found us. They noticed on our website, CareSuper prides ourselves on service, understanding our members' individual needs and our trustworthy reputation. So they popped straight into our head office to learn more. When they arrived, one of our member education specialists made themselves available to help in person. Our member education specialist sat down for more than an hour and talked through this person's situation in depth and about the benefits of joining CareSuper. They decided to join during the meeting and we assisted the member with every step of the joining process, including to call their current fund and ensure we had all their correct information needed to ensure a stress-free experience. They expressed their extreme satisfaction with CareSuper, explaining they never would have been able to organise their superannuation without our staff kindness, patience and expertise. This was the first time they'd felt fully supported and empowered with their superannuation since arriving in Australia. They vocalised that they will now become an active promoter of our fund and share this experience with their friends and network. We introduced a new personal member consultant role recently to help our members, and this story relates to a member's experience regarding this new service. In early 2023, our personal member consultant contacted one of CareSuper's members and introduced herself as his new personal member consultant with our fund. The member was delighted to hear that CareSuper have implemented this new service and said this is instrumental in preparing for he and his wife's retirement. Several conversations after, the member asked if it would be possible for our consultant to have a conversation with his wife. She was a member of a retail fund and unhappy with the cost of insurance and historical performance, so wanted to know more about how CareSuper might help. Our consultant spoke with this member's wife, who provided some information about her current fund and was really happy to hear that CareSuper offer insurance transfers and would be able to save her approximately $7,000 each year in insurance costs, money that could be retained in her super and continue to grow her retirement. Consequently, his wife decided to set up an account with CareSuper, and our consultant was able to assist her with the process of transferring her insurance and her balance. This is a great outcome, as the personal member service has now been extended to both of them, and they are comforted knowing they have someone at CareSuper who can help guide them to the right information and advice options in the lead up to their retirement. These stories demonstrate that we provide that extra level of service and that we're here to achieve the best outcomes for you, our members. If you have any questions about your super account, please don't hesitate to speak with a member of our team. They're all here to help you. I'd now like to acknowledge what a tough living environment we're all currently experiencing. It's been another year of economic uncertainty. The housing and rental crisis is far-reaching. Home affordability is at the lowest level in 30 years. We believe everybody deserves access to safe, stable and affordable housing. It's why we're proud to endorse the federal government's National Housing Accord in October 2022. With sustained interest rate rises and the ever-increasing costs of living, the past 12 months have continued to be difficult for many Australians and some of our members. Listening to and responding to the needs of our members and acting in your best financial interests remains our number one priority. Given the increasing cost pressures on funds and the benefits that scale can bring to members, we recognise that the growth of the fund is critical to our future success. In June 2023, we were pleased to announce CareSuper had entered into a binding agreement with Spirit Super to merge our two funds. The combined fund will leverage the strengths of each to serve more than 500,000 members and manage almost $50 billion in funds under management. More importantly, there will be clear benefits for members of our merged fund. For example, creating a bigger fund helps us keep downward pressure on fees. Michael will talk through more of the merger details, but I believe there is true alignment of values and members between both funds. This is a fantastic opportunity to be a merger of equal, building a national fund, leveraging the strength of both. CareSuper and Spirit Super are both top industry super funds and share a vision of being a sustainable, mid-sized fund and leaders in member experience, driving strong retirement outcomes. The merger is due to take place in late 2024. I look forward to continuing in my role as chair of the newly merged fund. Until then, it's business as usual for both our funds. Which brings me back to our core purpose, helping our members maximise their super savings and achieving a better life after work. It's been great to see that there has been a willingness by government to think about how super funds invest, for example, in housing and other significant areas of public interest. The government has had positive engagement and are looking to partner with super funds, which is great for our members and your returns. There's been some regulatory reforms as expected, and Michael will talk more about these. I'd like to now update you on news with changes to our board and leadership. We've had a notable change in executive leadership, a director change, and we have also welcomed many new staff members over the past year. I'd like to acknowledge firstly our recently outgoing CEO, Julie Lander, who retired early this year, for her dedication and commitment to successfully leading CareSuper over the past 21 years. Julie made a significant contribution not only to CareSuper, but to the wider superannuation industry. Her diligent stewardship has driven the fund growth, strong long-term performance, and thriving culture that we are well known for. Following Julie's departure, we welcomed Michael Dundon, who stepped into the CEO role in March 2023. An experienced fund executive, Michael has made an immediately positive impact. Already, instrumental in leading CareSuper's growth towards being one of Australia's leading challenger funds to the larger funds. With Michael's expert guidance, strong leadership and prior experience with mergers, you can be assured you're in very good hands. In January, we welcomed Dr. Michael Drew as our new Employer Director, who stepped in to replace Michelle Gardner as the Chair of our Investment Committee. I'd like to welcome Professor Drew and express my thanks for his contributions this year. And thank Michelle for her invaluable service to our members and employers since her appointment in 2019. In other thanks, our staff and service providers have worked so hard to support our members and employers. I thank them for the care and commitment they've shown. And my last thank you is to you, our members. Everything we do and every decision we make is done so with you at the forefront of our minds. In closing, I want to thank you for joining us tonight. Our strategy remains to be the strongest mid-sized fund in the market and the leading competitor to those larger funds. We believe our size is an asset as it enables us to invest actively and in assets that differentiate us. We also maintain that it's in the national interest to have diversity of fund size and to continue to achieve strong returns and provide relevant services. We believe our merger with Spirit Super will set us up for the future and, most importantly, is in the best financial interests of all of our members. It's not just about size and scale, but being able to provide support and personal service to help you with decisions throughout your life. We look forward to the privilege and responsibility of continuing to manage your superannuation for a better life after work.
Thanks, Linda. I'd now like to introduce Michael Dundon, the Chief Executive Officer of CareSuper. As Linda mentioned earlier, Michael joined CareSuper as CEO in March this year. Michael is responsible for developing and executing the CareSuper business strategy and the overall management of the fund, including our 200 staff. Supported by the executive team, he ensures there is a clear focus in acting in members' best financial interests and assisting members and employers every day to make the most of their super. With over 30 years industry experience, Michael has a strong track record leading and consulting to super funds undertaking mergers and is ideally placed to lead the fund through this process. Michael holds a Bachelor of Economics, is a graduate of the Australian Institute of Company Directors and is a Fellow of the Institute of Chartered Accountants Australia. Could you please welcome Michael?
Good evening, everyone, and thanks for joining us tonight. It's been an honour to step into the CEO role at CareSuper. I'd like to firstly thank our loyal staff and service providers who've worked tremendously hard to support our members and employers throughout the year. I've really enjoyed interacting in person with the CareSuper team. Our team has continued to embrace our hybrid working arrangements and have worked flexibly to tailor meetings and workplace seminars to suit members' and employers' needs. Providing opportunities like this to engage and connect with our members is an important part of our product and service offering. Acting in our members' best interests has always been at the core of why we do what we do. We are purpose-driven to help you build financial security and maximise your retirement savings. And we are clear on the value and experience we deliver by anticipating your needs for different life stages, by offering expert guidance and by building knowledge that enables informed and confident financial decisions. Tonight, I want to cover three main themes. Firstly, I'll show you some of the key statistics of the fund for the financial year. I'll then discuss further details of our upcoming merger and how we're setting ourselves up for the future to further benefit our members. And finally, I'll cover some of the recent legislative changes and other key projects we've been working on. Let's start by looking at some of the key fund statistics. Our funds under management have increased to over $21 billion in assets. Our strategy is to remain a mid-size fund. We're well positioned to be a credible, compelling and successful alternative to the funds of all sizes. Our size is important to our proposition. This enables us to remain agile, to take advantage of investment opportunities that would not be available to much larger funds. CareSuper remains a sustainable and highly regarded super fund, with more than 30,000 new members joining during the year. Our focus continues to be on serving our members well and building a strong fund for long-term success. In 2021, APRA introduced annual performance tests on all funds MySuper products. As anticipated, our balanced MySuper option that most of our members are invested in passed the test again. I'm also pleased to report CareSuper's products and services were recognised by superannuation industry providers and researchers throughout the year and maintained the highest ratings from all agencies. Specifically, I'd like to call out two in particular: Super Ratings MySuper of the Year and Smooth Ride Award for 2023. These awards recognise CareSuper as having the top value for money default super investment option and for protecting our members' super over the long term, meaning strong long-term returns for you. Making a positive difference to our members' lives and helping you achieve a fulfilling retirement is our purpose. So top ratings and these awards provide confirmation that we have a history of strong investment performance and quality product that will help you achieve your goals. We know it's not all about awards. As well as being the super fund for life for our members, we aspire to be highly regarded by our stakeholders, including employers, intermediaries, regulators and service providers, as a good corporate citizen. I won't talk too much about our investment performance, as Suzanne will cover that in detail, but would like to say it's been an excellent year for both super and pension members, with great results achieved, especially considering the economic uncertainty during the past financial year. I'd now like to move to my next item, the merger we announced late last year, and demonstrate how we're setting CareSuper up for continued future success. As Linda mentioned, the merger is officially due to take place in late 2024, so for now nothing changes for members. However, there has already been lots of hard work in the background to prepare for this. We're confident our coming merger with Spirit Super is a step towards ensuring positive outcomes for CareSuper members and is in fact critical to our future success. The merger is in all members' best financial interests. Some of the benefits we see for members include an anticipated reduction in administration fees, utilising Spirit Super's award-winning in-house administration model to give us the platform to further improve our member servicing capability. Increased scale to access investment opportunities that we cannot currently access, and the ability to provide additional products and services. I believe Spirit Super is a great fit for CareSuper as a merger partner, and we will share more information and keep you updated on any changes as we get closer to the merger next year. Speaking of business as usual, it's been a busy year for us and for the super industry on the whole, with several legislative changes that came in from 1 July, such as the super guarantee increase from 10.5% to 11%, the return to normal minimum payment drawdown limits after their 50% temporary reduction during the COVID pandemic, the transfer balance cap, which is the maximum amount you can transfer from a super account to a pension account, was reinstated to 1.9 million. The threshold for low and middle income earners to receive government co-contributions has increased. This gives more members a chance to boost their super. In March 2023, we released our Net Zero Roadmap. We acknowledge climate change is a systemic risk that has the potential to significantly affect our members' retirement outcomes. That's why we're committed to reaching net zero greenhouse gas emissions across our investment portfolio by 2050. This builds on our existing program to manage climate-related risks and deliver our members strong long-term returns. We care about making a positive difference to our members' lives by helping set you up for a better future, and we know that climate change is a systemic risk that extends to all sectors of the economy and has the potential to significantly affect your retirement outcomes. Committing to net zero carbon emissions by 2050 is both in line with your best financial interests and aligns with your expectations. It will also help us take advantage of potential investment opportunities to create further value for you. You can be assured that we take a responsible, considered approach to investing your super and running your fund for the long term. You might have seen in the news that some funds have been found to have been greenwashing. This is when a fund exaggerates their environmentally friendly actions or claims that their investments are more green than they really are. We're committed to communicating genuinely about our green credentials and practices. We've been reviewed by the regulator and they confirmed our approach is sound and that we are not greenwashing. In April 2023, we updated our insurance offering to help us deliver flexible cover that continues to meet our members' needs. This allows us to remain affordable and fair over the long term. Plus, for most of our members, your insurance fees will be even lower, meaning more super for you. Another key project is our Voice of Customer. We value our members' feedback and strive to improve through this work. We have dedicated staff who review this feedback to identify opportunity to improve. Since its launch, we have assisted numerous members with callbacks and resolution of inquiries by working with our back-of-house teams and streamlining processes. So we are not only listening to your feedback, but taking action where appropriate to provide our members with service they can trust and rely on. In addition, we've been working on refreshing our education hub on our website, which offers a great range of resources for members at every stage of life. I would encourage you to take a look on our website, and I would also remind you that we offer financial advice over the phone regarding your super or pension at no additional cost. I encourage all members to book a call with one of our financial planners who can answer any questions you have regarding your super, pension or finances in general. Face-to-face and more complex advice is also available for a fixed fee, which is discussed with you up front. As you can see, it's been another big year for CareSuper, and although I'm honoured to be leading the fund through the merger, I'm most proud of our continued focus on being a fund that cares deeply about each and every member. In closing, I want to take this opportunity to thank you, the members who have supported CareSuper. I'd now like to hand back to our MC, Paul.
Thanks, Michael. And ladies and gentlemen, please keep those questions coming in. I'd now like to introduce our final speaker, Suzanne Branton, CareSuper's Chief Investment Officer. Suzanne is responsible for the management of CareSuper's investment portfolio and leads a team of dedicated investment professionals who work hard with great expertise to deliver strong outcomes for our members. She works closely with the CareSuper board and its investment committee to develop the fund's investment strategy with a strong focus on investment governance and risk. A proven leader with almost 30 years' experience in financial markets, primarily within superannuation and asset management, Suzanne has extensive expert knowledge of portfolio management across all asset classes. She's experienced in portfolio strategy and design, asset allocation, manager research and selection. Suzanne has managed the investments of profit to member super funds for the past 16 years. And prior to this, she held various senior positions in investment strategy and financial market economics at Goldman Sachs and JB Weir. She holds a Bachelor of Economics with honours and a Graduate Diploma of Applied Finance. Suzanne is a Fellow of the Financial Services Institute of Australasia. I've worked closely with Suzanne for the past 6 years and I've witnessed firsthand the talent and expertise she brings to managing our members' retirement savings. She faces the challenges of incredibly complex markets and she meets them head on with a passion for delivering great outcomes. Could you please welcome Suzanne?
Thank you, Paul. Good evening, everyone. I'm so pleased to be here tonight to provide you with this investment update. One of the main aims of this member meeting is to review the financial year. So tonight I'm going to talk about our performance for the 12 months to the end of June 2023 and the drivers of those results. Then I'll spend a bit more time discussing what's happening in investment markets at the moment and some of the themes going forward that we think will be important. Let's start this session today with the results of the past year. The 2022-23 financial year was positive for our members, with most of our options recording strong gains. We're proud of our balanced options result, a return of 9.1% for super members and 9.6% for pension members. To start with, let's examine the returns of all CareSuper's managed options, specifically looking at their performance over the past 12 months, up to 30 June, and the past 10 years. The chart compares the 1-year returns in blue with the 10-year returns in grey. The balanced option, where most of our members invest, is shown on the left with a return of 9.05% in the last year and an average of 8.04% per year over the decade. CareSuper offers a range of premixed or diversified options catering to different investment preferences and risk profiles. Moving towards the right, we have the growth option, which allocates more to growth-oriented investments like shares. Then you can see the 1 and 10-year returns for alternative growth, sustainable balanced, and conservative balanced options. And we end on the right with the capital stable option. This option has a higher proportion invested in more defensive asset classes. As the chart illustrates, the growth option has the highest 1-year return at 11.7%, and the average return over the past 10 years was 8.95%, reflecting its design to deliver higher returns but with some higher risk. And here we see similar results for the pension options, but with slightly higher returns as the pension members don't pay tax. If you would like more detail on the returns of different options, including the single asset class options, please go to the investment section of our website. In considering the results of the different options, there are key points of interest. Firstly, the riskier options that were shown on the left, which have a larger proportion invested in growth-oriented assets like shares, performed well over the year, thanks to a substantial rise in share prices. Second, it's noteworthy that last year's results were higher than the 10-year average, so it was a strong year. I mentioned shares did well. That was both overseas and Australian shares, even in the face of rising inflation and interest rates, which typically have a negative impact. Overseas shares returned around 20%, led by strong US tech stocks and excitement about artificial intelligence. The Australian share market also delivered robust returns of over 14%, primarily driven by strong demand for resources and commodities. By contrast, interest rate sensitive investments like fixed interest and direct property had a more challenging year. Last year's results were really driven by rising share prices, but many of you have seen that share markets have struggled in the current financial year. For example, in the September quarter, CareSuper's balanced option rose by a modest 0.4%. However, according to Super Ratings, the median or the average fund delivered a decline of 0.5% in the quarter. While we never encourage members to pay too much attention to short-term results, it's a good reminder that trends across different types of investments are constantly changing. So one of the best strategies has always been to diversify across a mix of asset classes. Our investment approach is always focused on diversification and active management, allowing us to navigate through various market cycles and downturns successfully. We firmly believe in protecting our members' savings, which means delivering a higher return, but with less risk. This is a big challenge, but one that our team has achieved year after year. And we're recognised in the industry for this achievement. We're ranked number 1 by Super Ratings in the risk-adjusted survey over 10 years and proudly received the 2023 Smooth Ride Award, which recognises our measured approach to investing and how we achieve strong results while protecting our members' money. Our discussion so far has focused on recent trends, but consistent long-term results are what counts. I'm pleased to confirm that CareSuper's returns remain strong compared to other funds across the industry. Our balanced option has delivered an average return of 8% annually over the past decade, placing us amongst the top 10 funds in Australia, according to Super Ratings. We're also amongst the top 10 performers over 15 and 20 years. Now let's come back to the outlook for investors. Over the past few months, we've seen quite a bit of volatility in global share markets and some modest declines, mainly as it's become apparent that central banks will keep interest rates higher for longer than hoped. What central banks do influences mortgage rates, but it also has implications for market interest rates, such as for bonds or fixed interest securities. The following slide helps us to understand just how much interest rates have risen around the world. Here we consider interest rate trends in the US since 2000, so the past 23 years. The black line is the US cash rate, or the rate set by the US central bank. The green and blue lines show market interest rates, the yield on 2-year and 10-year securities in the US. These are fixed interest securities owned by investors, and when the yield on these securities rises, the value of the investment declines. The rise in all these interest rates over the past 2 years has been significant and rapid. The pressure that higher rates place on economic growth comes from higher borrowing costs for companies and individuals, and significantly higher mortgage rates. The higher interest rate structure we now see around the world is pivotal for movements we're witnessing across all financial markets, as interest rates influence the value of all investments. The path forward for central banks will be influenced by inflation trends, which currently pose a challenge for investors to predict. Globally, there are forces shaping the outlook that could lead to higher inflation, such as deglobalisation, and others that suggest lower inflation, mainly the likelihood of slower growth in the major economies. And this brings us to our third theme, which is about expecting ongoing volatility in markets. In such an environment, focusing on the two fundamental principles at the core of CareSuper's investment approach becomes essential: actively managing investments and maintaining a defensive investment strategy. And lastly, it's important to highlight the impact of global efforts to address climate change and the transition towards cleaner energy sources on our economy and investment landscape. This is a crucial issue for both governments and investors alike, as it encompasses both the structural changes arising from the shift in energy use and the potential investment opportunities in emerging technologies. As always, we remain focused on effectively executing our active approach. That's about being selective, taking advantage of investment opportunities, and controlling risk to protect your super during periods of uncertainty. Thank you for joining me tonight, and I look forward to answering your questions. I'll now hand back to Paul.
So thank you to all our speakers tonight, Linda, Michael and Suzanne. Ladies and gentlemen, that ends the formal part of tonight's member meeting. We hope that we've provided you with a very real and substantial update on all the major strategic, environmental and management factors which the CareSuper board, the executive team and staff are focused on your behalf as members of CareSuper. If you have any questions about your specific super account, or you would like to talk to one of our financial planners or member education specialists, please call 1300 360 149 or visit caresuper.com.au/advice. I mentioned earlier we have 30 minutes allocated to answer as many of your questions as possible. We will be publishing response to all of the questions asked to our website within 30 days. And if we don't get to your question tonight, rest assured that we will provide a response as part of the minutes from the meeting. I'd now like to welcome all our speakers back on screen. Good evening, everyone. We're now live with you to answer your questions, and all our presenters are here. Joining our speakers on the panel tonight is also Dan Bridgeland, the manager of our financial planning team. Welcome, Dan. Thank you. Some questions we can't answer tonight as they are personal advice. So Dan is here to assist where he can, but we do encourage you to look at financial advice if it's right for you. We also have in attendance representatives from our auditor, as well as members of the board. But now let's get to your questions, where we've received many questions in advance, so we'll be able to answer some of those, but you can continue to ask questions at any time over the next half hour. So to ask a question, simply click on the speech bubble icon on the right-hand side of the toolbar at the bottom of your video player. And once you've typed your question, press submit, and we will look forward to getting to those questions if time allows, but we'll be publishing answers to those questions as we'll explain at a later date. So on to our first question, and we've had a similar question from many of our members, and there's a lot of interest in this topic, and I'm going to ask Linda Scott, our chair, to answer this question, which is, why is the merger happening?
Thanks so much, Paul, and thanks to all our members for this really important question. Of course, CareSuper and Spirit Super agree that a merger is an exciting opportunity for both our funds, and of course, both funds are highly regarded, award-winning and high-performing. The merger will provide our members with the best of both funds. CareSuper's history of a strong return portfolio and active investment approach that ensures a smoother ride, and Spirit Super's outstanding in-house administration model. The increased scale from the merged fund will also allow us to provide additional products and services. This merge will create a combined fund of more than 500,000 members and almost 50 billion in funds under management. The funds share a vision to leverage the strength of our two funds and create a national mid-sized fund that provides a distinct point of difference for members. CareSuper and Spirit Super announced the merger earlier this year, and we will send written notification of the merger to all members as we approach the merger date.
Thanks, Linda. Similarly, the merger is of real interest to our members, and we have another question related to the merger, which I'll ask Michael Dundon, our CEO, to answer, which is, how will the merger affect the fund, and how will members and their super be affected?
So thanks very much for that question. It's a great question. So nothing will change on your account in the way we manage your account right now. The merger is expected to be completed in late 2024. So as decisions are made for the future, we'll communicate with you. All members will receive individually addressed written notification of the merger and include any impacts on our services. So we will be issuing a significant event notice, or what we call a SEN, an SEN, as we approach the merger date.
Great. Thanks, Michael. And while we have you still online, we have a question from a member of ours, Kayleen, and she has asked, who are Spirit Super? Perhaps if you could give us some background and explanation of Spirit Super.
Yeah, thanks, Paul. So Spirit Super is a relatively new brand name, but the fund has a long history. Spirit Super emerged from the merger of MTAA Super and Tasplan. It's a profit for member super fund with approximately 27 billion in funds under management and more than 335,000 members Australia-wide. And you can find out more about Spirit Super by logging onto their website at www.spiritsuper.com.au.
Great. Thanks, Michael, for those that interesting background on Spirit Super. I have a question here from a member of ours, Miranda, who's asked a question which is, what's the best way to invest my super and how to do it? And I think that might be a great question for Dan Bridgeland, the manager of our financial planning team.
Yeah, thanks for the question, Miranda. As a CareSuper member, you have access to our limited advice financial planning team who can provide advice to you over the phone at no extra cost because it's included in your membership. One of the topics they can advise you on is how to choose the right CareSuper investment option for you. And to do this, they'll work with you to work out the right amount of investment risk for you, which is called your risk profile. They'll ask you a range of questions to understand things like your investment time frame and your ability to tolerate market volatility. Then they'll recommend the CareSuper investment option most suited to your personal needs and circumstances. You can access this team as many times as you like. So if you haven't reviewed this, I strongly encourage you to reach out to us so we can help you get your investments set up the right way for you. It's actually quite simple with our support. They can also advise you on some other topics like contribution strategies, reviewing your CareSuper insurances, beneficiary nominations, and they can also help you understand how you're tracking and what kind of income your super may be able to provide you in retirement. I will say we've had a lot of questions come through, and some are very specific, so we won't be able to answer all of them in this forum. If you still have questions, you can request a call back from a financial planner through the email we'll send you after this event, or our website at caresuper.com.au/advice, or by calling our contact centre on 1300 360 149. We're here to help.
Thanks, Dan. That's really helpful. And for our members, financial advice is such an important thing to engage with. We'd really encourage you to seek out financial advice when you have those important questions that you're looking for help with. Now, we have a member, Robert, who is asking a question about, perhaps for our CEO, Michael, what is your view on the importance of customer service?
Yeah, thanks, Robert. At CareSuper, we put our members at the forefront of everything we do. We're continuously training and developing our consultants in order to deliver a high quality of service to all of our members. And we appreciate any feedback that we receive in relation to our service. So please don't hesitate to get in touch with us at any time.
Thanks, Michael. That's great. And thanks for that question, Robert. Our next question is for Suzanne Branton, our Chief Investment Officer. And the question is from our member, Timothy. And Suzanne, Timothy's question is, what do you think will be the most impactful factor for fund performance over the next 10 years and why?
Thanks, Paul, and thank you very much, Timothy. Look, that's a great question. The next 10 years, we think will be a very interesting period in markets and most likely to be quite different from the last 10. Look, notwithstanding, it is difficult to characterise or make a general statement about a 10-year period because there's likely to be several different things happening over that kind of a long time frame. You'd expect there'd be a couple of different economic cycles, there'd be different trends, you would have periods of up and down over that kind of period. But if we're going to try and characterise what we think some of the dominant factors might be over that time, we do think it's more likely to be an environment where we're going to see perhaps higher interest rates than we saw for the past 10 years, and also most likely a bit of a higher level of inflation on average. Now, that doesn't mean we don't expect both of those key factors to move up and down over that time. But if inflation is going to be a bit higher over that horizon, then that does have some implications for how we invest and what members could hope to expect. So higher inflation, why might that be the case? And I can give you a bit of a flavour for why we think we might see some higher inflation over time. One reason is potentially climate change. So the transition to cleaner energy is likely to require a lot of investment and also might make things more expensive. That's commonly believed to be a very important change that governments and consumers and industry will need to go through, but it is thought likely to potentially lead to some higher inflation. And another reason likely to put some upward pressure on prices could be deglobalization. Countries around the world are taking steps to bring manufacturing and production back onshore or changing the location of where things are made. And I'm sure you can also see from events around the world at the moment that there is some conflict and some change in supply chains. Another factor likely to feed into inflation over that sort of time horizon would be technology. Technology typically provides advancements that actually dampen inflation, and that will probably be something that does contain inflation over that period. So what does that all mean for how we invest and what investors might see? It is likely to mean interest rates remain at what we would now regard to be a more normal level, which is where they've come up to. And that should be more challenging for investors. I did make some comments on that in the presentation, but just to extend on the remarks earlier, the higher rates are more challenging for lots of types of investments because it means that money has a higher cost And investments have to return more to make up for that cost. And it puts a strain on borrowers, not just us consumers, but also businesses as well. So if businesses are paying more of their profits out to go towards interest payments, then there's less coming potentially back to investors. So that all really means that there is a chance of some more volatility. High interest rates typically lead to that. It doesn't mean, though, that the investment environment is necessarily a poor one or is going to be a poor one for 10 years. That is absolutely not what we're saying. It's more of a picture of variability and the likelihood of seeing ups and downs over that period. But it is very likely that there will be times that will generate quite good returns. So it's not an easy picture, but it's one where diversification is really important. And needing to have a very diverse portfolio will be quite valuable, we think, in that time horizon, as will be our investment approach. I did mention that in the presentation, that we think that our investment approach and the way that we invest will really be valuable for members into the future. And that's because we're focused on providing strong returns, but with less risk. And as I mentioned in the presentation, we think that will be something that members will really see the benefit of. So I'll hand back to you, Paul.
Thanks, Suzanne. That's really helpful. And we know how many of our members have expressed interest in what is going on in markets, how they are affecting investments. They are very conscious of cost of living challenges that are being faced at the moment. So that's undoubtedly very helpful, and perhaps similar, with people being conscious of the costs of living, and slightly associated with this, we have a question from Karen, and I might ask Michael Dundon to come in and answer this question. And Michael, Karen's question is, what are you doing to keep fee costs down?
Yeah, thanks, Paul, and thanks, Karen. It's a really good question. It is a challenging task in this high inflationary environment, but as a profit to member fund, we work very hard to keep our fees down. That's our objective, very key part of our success. And we're proud of the low fees and the great value we've offered, and that's resulted in our balanced MySuper product being ranked as top value for money default super investment option, winning the 2023 MySuper of the Year award, coming from the independent ratings agency Super Ratings, who rate all of the superannuation funds across the industry. And even more so, over 15 years to the 30th of September 2023, Super Ratings modelling showed that our balanced option returned over $36,000 more than the average of all surveyed retail funds, and outperformed the average of all surveyed industry funds by over $13,000. So really strong outperformance for members of CareSuper. And finally, as an industry fund, we are transparent about our fees. There are no commissions or sneaky fees that we hide away. All our fees are outlined on our website, and you can see them at caresuper.com.au/fees.
Thanks, Michael. That answer is really helpful, and really important to emphasise that need to focus in on net benefit. Fees are certainly important, but also the returns that get generated on your vitally important savings. So that's a great question, Karen. Thank you, and thanks for the answer from Michael. Okay, well, we've got another question here, which I think is a really important topic, particularly around the important role that insurance plays for our members, for supporting their families and for themselves. And we have a question, Michael, which I might ask you to respond to again, which is from our member, Abdul. And Abdul's asked a question about income protection, and he just wonders whether you can provide some insights about what we've seen in terms of income protection.
Yeah, a really important issue, insurance. So thanks, Paul. And it's interesting to note that during the financial year ended 30th of June 2023, our insurer, MetLife, actually paid 100% of all income protection claims assessed, with the primary claim causes being injury, illness, and cancer. So income protection provides an important safety net for members who cannot work for an extended period of time due to illness and injury. And our cover offers benefits for 2 years, 5 years, and to age 65, with 30, 60 and 90-day waiting periods available. For assistance on what cover might be right for you, you can arrange to speak to a financial planner by calling us. And the funds recently enhanced our income protection benefit by introducing the ability to increase your income protection insured benefit once in every 12-month period with written confirmation of a salary increase from your employer. Obviously, some conditions apply, but please refer to the CareSuper Insurance Guide for details, as this may be very helpful for you individually.
Great, thanks, Michael. That's really important information for Abdul, but also for our members broadly. So thanks for answering that question. Ladies and gentlemen, we're making good progress on our questions, and we encourage you to ask questions if you have them through online. And even if we don't get to our questions tonight, we will certainly publish answers as part of our transcript following the annual member meeting. Just going back to what's happening in investment markets and how that's impacting member savings and their retirement savings, I have a question here from our member Trevor, and I'm going to ask Suzanne and invite her to come to answer this question. With all the unrest in the world, how is CareSuper managing our funds to make you safeguard members' funds? What is your strategy, given the present climate, to reduce losses to a minimum? So Suzanne, I'll get you to respond to Trevor's question.
Thanks, Paul. Thank you. And thank you, Trevor. That's a very important question. I might tackle that in two parts. Perhaps it's might be more sensible first for me to start about the aspect you referred to about how we keep losses to a minimum. So let's begin with that, and then perhaps I might come back to the unrest. So keeping losses to a minimum is really important. We've mentioned in the presentation and also in my earlier answer to the previous question about our investment approach and how we control risk and how we deliberately try to avoid losses. I describe that as having a dual purpose, return and risk. We sometimes refer to that as the smooth ride. And if you see reference to the smooth ride, that's really what we mean when we're talking about our investment strategy and the way that we look after your money. So the answer really is then that containing losses and keeping losses to a minimum is actually inherent to everything that we are doing. And we're one of the few funds that actually have that as a deliberate part of our strategy. I'm often asked, well, how do you actually do that in practice in managing the investment program? So it might be helpful for me to give you a little bit of an insight into what that actually means we're doing when we're managing your investments. What it means is that we think about risk as well as return when we're selecting every single investment that we put in the portfolio in every asset class, one at a time. So we're choosing them on that basis, and we're assessing when to go in and out of them, when to increase or decrease those investments. So that's what we call bottom up. So bottom up meaning we're looking at every individual investment one at a time. We're very active in the way we do that and very agile. It's also important and the way that we achieve this smooth ride, to talk about how we invest in different asset classes. So how much we have in each asset class, when we might change that, when we might look to modify that, how we might build asset classes within different diversified options. So, for example, how much private equity does the balanced option have, or how much property or how much infrastructure is in the capital stable option? And how do we move that given different points in the cycle and different global events? Being active is something we talk about a lot, and we are very active investors. And when you're active, it means that you are thinking, responding, analysing and changing your investments, which means that you can adjust to risks as they emerge in the environment much better. So there's some of the ways that we actually achieve this outcome of keeping losses to a minimum. Now, I might now come back to refer to your comment about unrest in the world. No doubt, tragic, concerning on all levels, in different ways, in different places that we see that these days. Investment markets do react to these events, and we do see reactions and responses in markets, and they're things that we pay a great deal of careful attention to. But markets tend to look at these sorts of events that you've described as unrest in the world through a lens of the implications that that might have for economies or for businesses or trade. So investment markets often might have a bit of a different focus to what we might have when we're looking at these events. And they certainly have had an impact, but that has been intertwined in the mix of other fundamental influences that we're seeing at the same time. So such as the interest rate inflation trends I've referred to, or what central banks are doing, or what's happening, for example, in currency markets. Now, we are always assessing all of those influences and their implications, including the impact of unrest on different types of investments and the investment portfolios that we manage for you. It's a key part of our process, and it is something that we are constantly monitoring, as well as all the things that you would usually expect us to. And we have a history and active approach to managing them. And looking back through the history of these events, certainly in recent times, events, say, for example, in Russia and Ukraine, we made specific changes to the portfolio at that time in response. So how we're investing is important, but given we're talking about risk and recent events and current events, it's probably a good idea for me to remind members that it's good to be comfortable with the investment that you have and to understand where it sits in the risk spectrum and that it's right for you. We do have different options for different risk appetites. You can do that really easily by checking your balance, going onto our website and having a look at the option that you're invested in. Look for the pie charts that show asset allocation, and look for the things that show risk level. That can really be helpful. So I've talked a bit about recent events and current events and minimizing losses. I hope to have given you the clear understanding that we're doing a lot in the investment portfolio in actively managing your investments. There are always ups and downs in the past and in the future, but we're doing so much in the portfolio in support of your retirement savings. That hopefully means that our members can focus on staying the course and also thinking about the longer term nature of superannuation as an investment. But if you do need help with what you're invested in and the risk levels, or you're concerned in any way, please reach out, potentially speak to a financial advisor, someone like Dan who can help you if you think that you would like more information. I'll hand back to you now, Paul.
Yeah, great. Thanks, Suzanne. That's a really thorough response, so thank you for that. We have another question that's related to the merger, and this member, Khan, is asking a question which I'm going to ask Michael to respond to, which is, Michael, Khan's question is, will the super fund remain in Australia?
Yeah, great question, Khan. Thank you. Yeah, absolutely. Most definitely we will remain in Australia, and we'll continue to support our members through the offices in multiple locations across Australia.
Terrific, thanks. That's a very clear response, isn't it? So thank you, Michael. We have a question from Wilma, who is asking a question which I think Dan Bridgeland, our financial planning manager, is really well placed to respond to. And this is a question regarding the downsizer feature of what you can do in terms of contributing, Dan. Wilma's question is, if we downsize, can we use the $300,000 to start a new pension fund, or does it have to be added to an existing accumulation fund?
Yeah, thanks for the question, Wilma. I'll start by saying that with any financial planning decision, it's really important to consider your individual circumstances. So I'm only speaking generally tonight, but I might just explain what a downsizer contribution is. And this is where if you sell a property that was your primary residence at some point, you've owned it for at least 10 years, you may be eligible to make a downsizer contribution of up to $300,000 as an individual, or if you're in a couple, you may actually both be able to do $300,000. So $600,000 in total to add those funds into superannuation to use them to boost your retirement savings and fund your lifestyle. So the first step, there is various rules to this one. So the first step is to make sure that you meet the criteria to make a downsizer contribution. Then to make the contribution, it needs to go into a superannuation account. So if you already have a superannuation account open, you can simply make the contribution into that account. But if you don't have a super account, so you've already got your pension and you've closed your super account down, it's actually quite simple just to open a new super account so you can make the contribution in. If you've met your preservation age, which would be based off your date of birth and would range between 55 and 60, depending upon your age, you may then choose to, or you may be able to roll the funds from your super account over to a pension account. This can then be used to fund your lifestyle or fund your retirement and draw an ongoing income to support yourself. One thing to note is that if you already have an existing pension account, you actually can't add funds to an existing pension account. So what you would need to do is, if you'd made the contribution into a super account and you've got your pension account and you wanted to combine them, you could potentially consider opening a new pension account and then combining them together. There are limits to these rules, there are trade-offs, and there's a range of considerations here. So if you'd like some help to make sure you get it right, you can request a callback from one of our qualified financial planners who specialise in pre and post-retirement planning, who can help you make sure you're doing the best thing for your situation. We also present regular webinars on this and many other topics as well, and these can be found on our website at caresuper.com.au/events. And this is where you can keep up to date on what's coming and register to attend.
Great, thanks, Dan. That's a really helpful explanation. So appreciate that question as well. Ladies and gentlemen, we have time maybe for one or two more questions. We are getting close to the half hour of the question and answer section of our meeting tonight, but I have a question here from Shiv, our member. And Suzanne, I'm going to ask you to perhaps respond to Shiv's question, which is, can you provide an overview or a high-level overview of the performance of CareSuper versus other similar funds within the industry? And also, can you give us a guide, if possible, of management's performance forecast, your performance forecast for this financial year?
Great, thank you, Paul. Thanks, Shiv. I'd best be quicker with this one. So I think, Shiv, the first part of your question, I do think that Michael kindly answered in an earlier response in terms of the discussion about CareSuper's performance and performance history. So I hope that some of that was covered already in part. I may just mention, though, when you're looking at comparing CareSuper's performance to another fund or doing any fund comparisons, given you've asked about comparison between two funds, just some tips when you're doing that. Make sure that you're comparing apples with apples, so a balanced fund to a balanced fund, and you're matching the time horizons. If you're looking at June to June for 10 years, make sure it's the same for both. And also look at the longer term timeframes that include more market environments, more cycles. So 10-year numbers, 15-year numbers, and those sorts of comparisons will give you a better read. Now, Michael did mention our performance history and some of the awards that we've won. CareSuper is amongst the top 10 funds in the industry over the long-term timeframe. So we have a long history of being a leading fund in terms of our performance, and our performance track record's really consistent, which is what we're trying to achieve. Then in terms of forecast for 24, look, we don't make specific forecasts. We give some guidance on how we're thinking. I talked in the presentation about last year's returns being high versus the average. You wouldn't expect that every year. Hopefully that gives you a feel. I talked about us being fairly cautiously positioned about the outlook and things in the world changing. So we would expect that, this year might be a year that's got some different things happening in it that could present some challenge. Financial year to date to today, as an example, the balanced option is up modestly. It's about 2%. It's not a big return, but given what we're seeing in the world, that's quite a good outcome, that we're seeing a positive return given equity and share markets have gone down a bit. And that really reflects our ability to absorb some of that volatility. So I might leave it there in the interest of time, Paul, in case you're trying to get another question in.
Great, thanks, Suzanne. Great response. And we will be able to get one more question in. I think we might even get two, but let's see how we go. Michael, we have a question from our member Tanya, and it's regarding insurance. And Tanya's question is, will there be an increase in admin and insurance fees? And who will our insurers be once the merger is complete?
Yeah, thank you. Good question. Our insurance fees were reviewed in early 2023, and most members actually saw a reduction in their insurance premiums at that time. Pleasingly, MetLife is the current insurer for both CareSuper and Spirit Super, which should yield some benefits and some ease of merger integration for us. But with all these decisions, we really need to work through the process, work through the product design, and we'll communicate with you as we go along. And excuse me, bit of hay fever. So we'll communicate with you, and we'll be able to share with you any changes that may impact you in relation to the merger in due course.
Great, thanks, Michael. Appreciate that. So, ladies and gentlemen, thank you for all your questions. We've come to hit our time limit that's available, and we want to make sure that we get you away as we promised we would. We are really grateful for your interest in CareSuper and that you've taken the time to ask the questions which matter to you. It's great to have our members take such great interest in their superannuation. It's such an important personal asset, and I hope we've been able to help you be informed and provide the information you are looking for tonight. It's also great for us to hear from our members to understand the things that matter to you. So that is all the time we have for questions tonight, and it brings a close to our annual member meeting for 2023. I'd like to thank all of you for attending, and we hope that you found tonight's meeting helpful and informative. And again, can I remind you that a transcript of the meeting, along with a video recording, will be available on our website within 30 days, along with answers to all of the questions asked tonight. I know that we're only able to get through a small handful of them, and it was fantastic to receive so many questions from you, and all of those questions will receive answers as part of our recording of the meeting and available to our website within 30 days. Now, if you would like to connect with us, please call us on 1300 360 149 or contact us on our website. We've also listed all our social channels here on screen as well. So please make sure you do contact us for whatever reason you need to. We really encourage it. So with the end of 2023 fast approaching, can you believe it? We'd like to wish all our members the very best for the coming holiday season, for the year ahead, and we look forward to continuing to be of great service to you and to be your chosen super fund, which is such a privilege for us. So thank you again for attending tonight. Thank you to all of our presenters, and good night.